Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Welcome, and I'm delighted that you are joining us for the launch of our new podcast, Real Estate Investing Abundance. 3 times each week, we will bring value bombs of investment wisdom from the most successful and renowned experts in the industry. The focus is on passive investment in real estate to help you as our listeners develop financial independence to live life abundantly. If you enjoy the show, please take a moment, find us on Apple Podcasts, and leave us a review. Reviews are vital to growing our audience so we can help more people find their avenue to financial freedom. Each week for the first 4 weeks, we will do a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. So please go to Apple Podcast and leave us a review. Hello, enlightened investors. Would you like to receive 40% leverage cash-on-cash return with the returns of your investment capital within 36 months? I know it sounds unbelievable, but today we will be visiting with an accomplished general partner who actually delivered this to his investors. I'm your host, Dr. Allen. Are you perhaps a busy professional passionate about the work of your calling, but have come to realize that the hope of developing financial independence has taken a backseat to the priorities of your passion? If you can identify with this, I have great news. Steed Talker Capital is an investment company designed for you, the passionate, fulfilled, passive real estate investor. Go to our website and enroll in Enlightened Investor Circle. There you'll receive education and support for your passive real estate investing, no matter your investment experience and expertise. Our guest, Anthony Scandariato, graduated cum laude with a bachelor's degree in applied economics and management from Cornell University. Prior to co-founding his company, Red Knight Properties, he was the acquisition and asset manager vice president for Visions Properties, where he sourced, negotiated, and managed the acquisition of $594 million Class A office assets. Anthony, before we delve into the business of real estate, share with us a memorable experience from your formative years that helped you to be the person you are today.
Thank you again for having me on your show, Alan. It's a pleasure to be speaking with you and appreciate the consideration. Thank you for introducing a little bit about my background. As you mentioned, I used to work for another real estate sponsor. This is going back about, actually now 7 years ago. I was there full-time 5 years, and it was an excellent experience before starting my company, which is called Red Knight Properties, which obviously we'll get into, which focuses on value-add multifamily investments up and down the East Coast. We have about, right now, 400 units under management, which is about $55 million in AUM from New Jersey to Florida. So up and down the East Coast in 4 different states right now. And the experience that I got from my prior workplace was invaluable. It was another general partner I was working for, and I wouldn't be where I am today without that experience, to put it that way, Alan.
Sounds like a great way to get into the business without having to jump into it with your own company, which a lot of people do. How did you come by that opportunity?
Sure. So the opportunity to work for the other sponsor came about through networking. This business is a relationship business, no matter what side of the coin you're on, whether you're on acquisitions or even if you're in property management. If you're in property management, you need to network with vendors and contractors. There's always a facet of networking in the real estate industry. So that opportunity came through me just via networking and putting different connections together through, people that I was friendly with, that maybe I graduated school with, just referred me to other people in their circle and ended up landing the opportunity. So that was a springboard for my real estate career. And that was in early 2015.
You've certainly come a long way since those early beginning days in the industry, and you've done so in a short period of time. You've had a busy year and in a lot of ways productive. So what has this last year been like for you? So many unpredictable things have happened, certainly COVID, but COVID brought to us all kinds of different surprises. The real estate industry was counting on a recession, and just the opposite happened. We've gone into a feeding frenzy. It's a seller's market like no one predicted. So what's this last year been like for you?
Sure, it's treated us very well. We've been able to grow our business, basically double it. It was actually the first full-time year for me that I focused on my business in January of 2020. So that was interesting, but it paid off. We were able to close on 4 deals, which were larger. We focused on opportunities that are at least 50 to 200 units. So the average unit size, I think, was about 60 units or so. We were able to expand into other markets and other states. So we're able to still meet and also exceed our goals for 2020. And COVID did initially shock and slow everything down. I think every facet of the operating business for real estate just got pushed back a few months from those early March, April, May days when COVID first shook the nation.
Mm-hmm, yeah.
So all the acquisitions that we were under contract for already just got pushed back 3 months. And that was an interesting time. Obviously, the debt markets, for the most part, froze. So there was really nothing we could do but basically pray that we can get an extension from the sellers until we were hoping that it would blow over. And obviously it did, and it didn't. We were, from a standpoint of risk, where the areas we were investing in, and we still continue to invest in, are considered secondary/tertiary markets within an hour or two of a major metropolitan area, mostly in the suburbs, I would say. We had some infill suburban locations, but for the most part, we weren't investing heavily in the cities, gateway cities. It's never been part of our investment mandate. And we've always been in the Class C or so space. And what we do is we go in and we renovate the properties to bring it to C plus or B minus and improve the community. So essentially, we didn't change our investment criteria. We did think that the market was going to crash prior to even starting my venture with my partner. And it hasn't changed just because we saw what happened in 2008, obviously a very different type of crisis, but we just saw that the workforce housing asset class for multifamily, just occupancies trended up, rents always trended up. There really wasn't a major dip. And this time we saw the same things. I think the one thing that we weren't expecting, and as you said, Alan, was the collections loss with COVID. Now we're recording this in the middle of 2021, and we have some properties where we still can't evict the non-paying tenants, but now they're far and few between. And it appears that in the next couple of months, we'll be able to do so again. So things are getting back to normal, which is good. And during the whole 2020, in terms of the existing portfolio, we had to be very conservative on our distribution plan because really nobody knew what was going to happen. So for us to tell our investors, hey, we're going to hold off on paying your quarterly distribution 2 months from now, nobody cared. They actually appreciated that because you wanted to really hoard cash. So 2020 was very interesting, but we were able to see the light at the end of the tunnel.
Great job you have done with shifting markets, and who could have predicted where we would be this time last year. Of course, like you mentioned, it really has to do with the lending market and what the lenders are going to do, and they have tremendous power over this industry. We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet, investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Avestor is the world's first customizable real estate investment platform. Investors can build their own custom portfolios selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Avestor also enables other real estate entrepreneurs and syndicators to build and use Avestor's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at avestorinc.com. Avestor, real estate investing made simple.
if you can, take us through a case study, and you can do any one of the cases you've had within the last year or two. Just take us through that process of finding the property through due diligence, acquisition, and management of the property, and finally, return on investments.
Sure. So we look at income producing properties in the first place. We do we buy for cash flow, and we try to, as much as possible, force the appreciation through strategic improvements that we can make, mostly cosmetic, in order to increase the rent roll, and various different ways we can decrease expenses, whether that's passing through utilities or appealing property taxes. We try to really drive that net operating income as high as possible from where we purchased the property to where we want to be when we reposition it. So a case study of one that we actually closed on about a month ago, is a 51 unit property in northern New Jersey that we acquired actually basically January 1st of 2020. So it was a 14-month repositioning period. And at that point in time, we were able to we didn't want to sell the property. We think that the area is still going to appreciate, and we still think there's room in the rents as we continue to hold. So we actually ended up doing a cash out refinance. And basically what that meant was we went to another lender. We paid off we had a construction loan, which was called basically a bridge loan. We paid off the bridge loan with a permanent solution through Fannie Mae, and we were able to return all our investors, all 100% of our investors, including myself, because me and my partner invest to capital that we had initially contributed, plus give them a 24% IRR on their money, just through the refinance. The investors that we have, including ourselves, are still in the deal moving forward. We don't just say, hey, here's your money back and you're out of the deal. There's a cash flow waterfall split where they still participate in the deal. Obviously, we have to perform. Everybody was very happy with that. And the way we're able to drive so much value there, Alan, was we took basically it was a 48 unit complex. It also had 28 self-storage units as well. So 48 multifamily complex, and we were able to add 3 additional apartment units. We converted some vacant former retail that was basically in shell condition, and also former storage area. So we were able to go to the town, seek the site plan waivers and also the variances to convert to apartments that basically added a $50,000 net operating income increase to our bottom line over that time period. And on top of that, the rent roll, we were able to increase the rent roll by about 30% over that time period too. And but the way we were able to do that was through many different improvements: exterior, interior, new signage, new amenities, new furniture, outdoor furniture all over the place, benches, chairs, new landscaping, new hardscaping, new walkways. Instead of old concrete walkways, we use pavers. We've renovated, I'd say, about 90% of the units with new laminate flooring, new paint, new countertops, potentially painting cabinets. So we put in about $500,000 into the property. The value was essentially double from where we purchased it, and that was just over a time period. So when you're talking about markets, Alan, and where we are now, with rates still being so low, we don't really we try to buy assets where we know the rents are below market in the first place, like really below, and we're trying not to set the bar in the market at all. That type of increase in value, I believe, wasn't due to what's going on in the market being the seller's market or crazy low interest rates. I think we really did force the appreciation and the property. That's why we decided to refinance, because we're taking a risk too. If the property goes down in value over the next, let's say, 5 years, we would have to take a hit as well. But we really don't think so. So that's just a little bit of what we were able to do recently.
That is really amazing. We'll be right back after a word from our sponsor. As an industry-leading, relationship-focused, design-build construction firm, Mosaic Construction has worked in many different asset classes from multifamily to retail, medical, industrial, and commercial. Mosaic Construction works to execute interior and exterior renovations with their team of trades and project managers. Their experience with value-add improvements has resulted in increased ROI and long-term value of the assets. They work nationally in partnership with local trades to deliver thoughtful, problem-solving construction management solutions to all their clients. For a personal, no-obligation consultation, call Ira Singer, 773-491-3145, or email Ira at mosaicconstruction.net. You can also find Ira on LinkedIn. So what was the purchase price on the property?
The purchase price was about 5.5 million,
Okay.
and appraisal came back at 9.7.
Really? Wow. So you financed the whole thing with a bridge loan. There was no permanent financing on that property. That's interesting. What was the occupancy when you purchased
so the
it?
occupancy when we acquired it, it was actually two separate sellers, basically two adjacent lots next to each other. So the seller, when we acquired it, he is a sophisticated guy, but he's a very busy man. So in order for him to get us information, it was really pulling teeth. So we knew we had to do the bridge loan route. We were paying 6.5% interest only for 2 years. So it sounds high now, but it honestly wasn't terrible. And that was basically January of 2020. So so we were able to replace that with the more permanent solution. Now our rate is like 3.5% amortizing. We wanted to amortize as well in the event that interest rates do go up, the value does go down slightly. We wanted to protect that over time.
Yeah. So what was the vacancy rate?
So the vacancy when we acquired it, it was like maybe 4%, 5%. It was more of the occupancy was very high and actually still is very high. I don't think we have any vacancies due to just the really low rents and I would say absentee management situation. It was full, but the rents were just really low, and he would let people just, when their lease came up, he wouldn't sign a new lease. They would just roll month to month, and they just stayed. The occupancy was fine. It was just a matter of getting the rents up, and we did have to replace a lot of the tenants that were put in there, but we were able to do that within that time period. And there was a lot of work, but it definitely paid off.
You did say you were replacing a lot of tenants. So really, what was the turnover? What was the percentage of turnover in that 14 months?
So we try to minimize turnover as much as we can. And the turnover for this property, it was, I would say, I think I calculated it was like 15%. So
Really?
it wasn't terrible. Okay. It wasn't like 50%.
Yeah. How did you manage? You were doing interior renovations as well, but you didn't really have a turnover in order to do that in vacant units. So how did you manage those interior renovations?
Yeah. So this was actually the first deal that we ended up bringing on outside partners. So this is the first syndication, quote unquote. So we've done this before through, we owned me and my partner just personally owned about 70 apartments just on our own. So we did this before, and we would literally, with those, we would actually on the inspection tour go through each unit and write down, okay, this one probably needs, a new countertop. This one needs a new floor. This has carpet. So we would know every single unit. And we did the same thing because this is our first syndication. We wanted to make sure we blew it out of the water. We toured every single unit and did the same exact thing. So what we ended up doing was when we did send the rent increase letters to these tenants, then thankfully majority of them were before COVID even hit, which was another situation we had to deal with. They were really appreciative because there wasn't a management company before where we saw things that they didn't, and we actually offered upgrades. And most of them were, like I mentioned to you, improvements. So we were able to work around their schedule, except it's almost like you can't really do a full kitchen reno or a full flooring while they're there. It's tough. So little things we ended up taking care of for the tenants who wanted to stay, and then maybe they stayed at a family member's house or two if it was a little bit larger. But I have to be honest, I don't think much of the old was in the building now. We did almost full renos after they moved out eventually moved out of their units. We do sign 1-year leases. Some of the tenants did pick up and move, but now we replace them with a better tenant role and obviously higher rent.
Yeah. Wow. Interesting process. A lot of attention to detail. And you were actually specializing each renovation. You didn't do a full-scale renovation over the whole property. If you do want to sell it, you've left a lot of room for another buyer to come in and make improvements there. What was the average? What did it really average out per unit construction cost?
Yeah, it was about $5,000 a unit, and that's including exterior too. Yeah, like I mentioned, it was some of the units didn't really need full renos. Some of them needed light, so it balanced out. And I would say that the units are actually in decent shape. Like a lot of the units just really needed new appliances and other little things, but the exterior was awful. It was driving up to the property, it felt like you were in a war zone. So we really improved that dramatically, and that's where I would say majority. That's what we did from the get-go. We just right away started with the basically as soon as we closed. We had our landscaper and hardscaper up there to do a gut on the outside. So I think the exterior was a huge component to change that building around.
That makes so much difference, not only to existing tenants, but certainly to new tenants. They drive up to a shabby place. They don't even want to go inside and see the interior. Exactly. So it makes a huge difference.
Yep.
How are you finding your deals?
Sure. So the way that we find the deals, we really work the brokerage community, commercial multifamily brokerage community. So we find that, and I've done various different studies to determine what percentage of deals are actually off market without a broker. And in the markets we operate in, there's very few and far between. I think they're like 90% with a broker. So we really try to maintain and establish new relationships with brokers each and every day, because we're the lifeblood of their business and they're the lifeblood of ours. We try to reciprocate as much as possible. So this particular deal that we realized the investment on, it was actually on the market before. It was an interesting story to get into a long story, but essentially it was given to the broker where it's basically a 50-unit property. The broker actually got a 1,000-unit listing at the same time. So there was really no focus on it, and it played to our benefit because essentially they let the listing expire, and then I reached out after to see if it was still available. So that was a unique situation. Now moving forward, it's almost, there's an off-market situation, but you go through the broker still, or it's a property that the broker is about to list and bring to market, but you want to step in and see if you can work out a deal, because a lot of times sellers really don't want to be dealing with 20 different tours. They don't want to annoy their tenants. They just, if there's a credible buyer that's been closing, they just want to deal right with them. And so that's what we're seeing more and more now. So we're trying to still work and maintain our broker relationships.
Yeah, and brokers would like to do that as well, because preparing those offering memorandums is labor intensive. So they can avoid it. They like to do that. Enlightened investors will be right back after this important message. I hope you're finding today's show informative and enlightening, and that you will please take a moment to find us on Apple Podcast and leave us a review. Each week for the first 4 weeks of the launch, we will hold a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. Reviews are very important for growing our audience. Your review will be immensely appreciated and will help others find their avenue to financial freedom. From your perspective as an economist, and you certainly are, you've got that background, where do you see the commercial real estate markets going in the next 12 months? I know that's looking into a crystal ball, but you're an economist, so from your economic background, what do you see?
Yeah, it depends upon where rates are. Obviously, inflation is kicking in. So, real estate, in my mind, is always a hedge against inflation. And when inflation kicks in, rents typically do go up, and inflation's got to go somewhere. So we're seeing it also on the residential side, with single family homes where inflation has kicked in there. I think we've seen it a little bit on the asset side for multifamily. So I do think we're in a strong position moving forward, regardless of what type of different tax situations do come about. And I have my own opinions on that, but we don't need to get into that. So I do think the fundamentals are still strong, regardless of what's going on right now. And individual investors and private equity and the larger REITs have seen how the multifamily has performed during COVID, and everybody's relatively happy compared to retail or office, where there was more of a bloodbath.
Or hospitality.
Or hospitality as well, yes. That's actually the most. People are, I think, optimistic with the multifamily and consider it as still a safer investment compared to the rest of real estate. Obviously, the multifamily and storage and industrial have been the top three during the crisis. I just think from a macro standpoint, it has all the fundamentals, regardless of what type of tax changes come about.
Where do you think the deals are most likely to be found in the coming year or two?
Yeah, like I said, we were talking about the broker relationships. Definitely keep working your brokers. Yeah, I think they're going to be found in the middle market, which is where we play. It's very tough in our experience, and I worked on the institutional side, but for another sponsor. I mean, we would bid on property and there would be 20 other bidders. It's just hard to compete with that. And most likely they have a lower cost of capital. So the middle market, there's still not too many players. And by middle market, I'm talking anywhere between, let's say, 5 million and 20 million, that type of purchase price range. What you're talking about in terms of equity, anywhere from 2 million to maybe 5 million. So there's not that many players in this space. There's more because they're seeing the opportunity for sure. But I do think they're still going to be in the middle market and most smaller properties, because the larger institutions are just still gobbling them up at cap rates and prices that I've never seen before. I'm sure you can say the same thing.
Are you still going to focus on the tertiary markets? Or
Yes, we will still continue our business plan and how we set it up in the same capacity as we did prior to the COVID. As we come out of COVID, we just proved our hypothesis. Although we didn't think it would be a health crisis, we knew that something was coming financially as well. So it did come, but then it left. But I think there's going to be some long-term ramifications to it, but we'll get there when we get there.
Which sector do you think is likely to be the big winner in the next 36 months? Is it office retail is going to rebound, to hospitality, multifamily storage, industrial? Where do you think the opportunities are going to lie?
Yeah, I think it's going to be very similar. It's going to be with the multi and storage on the value add kind of garden style side. When we're talking about where the opportunities are, development has been harder and harder. Obviously, we are seeing what's happening with lumber prices and construction costs across the board as it relates to inflation as well. And it's getting tougher to develop. I do think that the existing undermanaged, underassessed multifamily is going to be continuing to flourish, because you're going to be buying at a discount to replacement cost every single time. Obviously, depending upon what type of multifamily you're buying. And that's why we like buying in the C plus range, because the replacement cost is just typically like 3 or 4 times of where you're purchasing at. So it's not going to get any better than that. So I do think development's going to be a little tougher, but it's also a good thing for existing multifamily owners that own the C to Bs, because that's just going to put pressure on their rents to go up, as the development rents have to go up, and your vacancies are probably going to be very minimal. It's just going to continue to put pressure on everything. So I do think it's going to be very consistent with what we saw during COVID. I hope office does, and you're seeing it, office and retail rebound. I think actually retail has been rebounding more than office, reading some reports recently, but we'll see what happens.
A lot of people predicting the death of retail, but it doesn't seem like that is going to happen. A big retailer just put in a new facility just half a mile from where I live. They certainly are planning on expanding. Before we go into our last segment, Anthony, share with us how our viewers and listeners can get in touch with you.
Definitely. We have a free ebook that I put together. It's only a few pages, but it's basically how to escape your 9 to 5 to achieve financial independence. And that's through real estate investing. So you can find that if you just go to our website, Red Knight Properties, and that's Red Knight with the K.com. It'll actually pop up if you're not a member, and all you need to do is put your name and email in, and then you'll get an email from me with sending that to you so you can check it out. So that would be the best way, because you'll get my contact information after you get the books. But you can find me regardless on LinkedIn, Facebook, Twitter, Instagram. Just type in my name or Red Knight Properties.
Sounds like an excellent ebook for a passive investor to look into. Anthony, share with us one of your most difficult setbacks, and we're not necessarily talking about entrepreneurial, but one of your most difficult setbacks, and how did you come through that time? What did you learn from that experience?
Yeah, difficult setback was actually prior to starting in commercial real estate. I was in consumer products and retail. It was a startup company that I ran with a couple friends out of college, and I ended up actually leaving that company. That was in 2014, and it was a big setback for me in my life because I really didn't know what I was going to do. And obviously it took the time needed, which was a couple months, or actually a few months, to reflect on my life and have different focus points that I needed to hit and explore different industries, and found real estate. I would say for me, I really learned the value of where you start out in your career is not necessarily where you're going to end up. And that's okay, because I thought I was going to be in that type of world for the rest of my life. But what I learned was you got to be able to adapt quickly, whether that's in a career or in your personal life. But obviously quickly meaning take the time to reflect first before moving on. But yeah, I just learned that life's short, and it's just good to reflect and then move on and learn something from it. I found that experience invaluable, and I try to pass that on to everything I'm doing in my life. Let's say a deal falls through and I really wanted it, and okay, there's going to be another one in a month. That's just the type of mindset you have to have. Some people like, oh, this deal fell through. Shit, let's just fold up the company. Or we're going to sit on our hands. This year's going to stink. That's just not the mentality a good operator should have. So trying to have different mindset goals given that experience that I had moving forward.
Life is short, unpredictable, and to be successful, you have to be adaptable. Yeah, good lessons there.
Sure.
How are you putting your success as an investor and entrepreneur to work to create universal well-being and abundance for all beings?
Yeah, I love what our company has become, where I have a lot of friends and family in my deals, to be honest, and I really love, especially with that case study that we did, giving them back all their money in a little over a year plus 24% return, and they're going to be getting cash flow. They're all coming in my next deal as well, and it's really cool to see how I'm able to grow my family, my friends, and obviously new partners have come in that have become close to me and my partner. It's just really great ecosystem to build our portfolio and our wealth together. It's just really fulfilling for me. Hope to plan to continue that in our investment strategies moving forward.
This last question, you're a very young man, so it may be a difficult question, but imagine that you have come to the end of your life, and as you lay on your deathbed, what will you look back on with your greatest joy and sense of satisfaction?
Oh boy. Yes, still a young guy. Hopefully at that point it would be spending more time with my family, and hopefully I'll be able to do that in my future years anyway. But I don't want to have regrets where I missed out on family time, whether that's being so involved in my company. And for me, it was good to start this company earlier in my life than later. So I'll be able to have some flexibility there, hopefully. So just hopefully I'll get to my deathbed with no regrets.
That's not very likely.
There will be something, but...
Yes, I don't know. A life without regrets is a life with no reflection. But yes, Anthony, it has been a pleasure having you back on the show. I really enjoyed the conversation. Thanks for being on the show.
Thank you, Alan. It was a pleasure.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steed Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steed Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steed Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at steedtalker.com.